You're talking about, serious food shortage, mainly in Europe. What our computer has been projecting, and I've said, for the last couple of years, that U.S. would go into a recessionary period, but Europe could go into a depression.
The CME group, keeps a very tight rein on their members, and if somebody is short and the long demands delivery, the first thing to do is the CME gets on the horn to the short, calls them up and says, "Do you have the physical to back this?" And of course, the CME will know whether they got it or not because they keep records of this sort of thing. But one of these days, that somebody's going to demand a huge amount of silver from the Comex, and the longs just the shorts aren't going to be able to deliver. It's as simple as that, and we'll see it in the price.
Something very unusual is happening in the market right now, and most investors are completely missing it. At first glance, the reaction to geopolitical tension doesn't make sense. Instead of gold and silver immediately surging, capital is flowing into the US dollar and Treasury markets. But that's how the system is wired. Liquidity moves first, and only later does the real repricing begin, and that shift may already be starting. In a recent tweet, Peter Schiff said, "Gold is almost $4,800. Won't be long before gold is back above $5,000. This highlights growing momentum in gold despite macro uncertainty. But beneath the surface, deeper structural pressure is building. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think, honestly, you should have a couple years of food, mainly because even with the worst case scenario aside, there's usually food shortages during war anyhow. You had, the victory gardens from World War II, etc. You already have energy protests and farmers going crazy in Greece and Ireland. Without, fertilizer, you're talking about, serious food shortage, mainly in Europe. What our computer has been projecting, and I've said, for the last couple of years, that U.S. would go into a recessionary period, but Europe could go into a depression. And when you look at the facts here, U.S. only gets 3%, maybe 5% max oil from the Middle East. So we're not looking at fuel shortages in the United States. But Asia's, dry. Europe is dry. So you see things outside much worse. And then this is, again, unfortunately, Trump just listened to Netanyahu. And the problem here is that he didn't consult with anybody else. And now Europe is paying the price for him listening to Netanyahu. And that's splitting NATO. It's a real mess everywhere you go. The only benefit out of this has been it's made Russia and China stronger. Yeah, I mean, look, the computer's been projecting that for 2032 anyhow. This is just how you get there. We do see that China will rise as the new financial capital of the world after 2032. And, I've said that, been on record, for a decade. And I mean, the United States won't completely fall apart in that sense, but it'd be more like the British Empire. It'd be a memory more than anything else. But you have also globally, everybody is so polarized, left versus right, that what you're simultaneously seeing is a move towards separation. So Europe will break up. You're seeing that already with, conflicts back and forth. Canada will split. The West will leave the East. United States will break up. I mean, you even saw, California, they wanted to separate. And I think the rest of the United States would say, yes, please go, and I'll give you a quarter for the bus ticket, but it's so at the same time, these economic impacts, what they do is they cause other disputes to rise to the surface. So, for example, you're seeing what our computer was warning about, that this would be World War III, but not like World War I or II, where it's one adversary you're facing. It's pockets of uprisings everywhere. So it's Thailand versus Cambodia all of a sudden, India versus Pakistan, and Pakistan versus, Afghanistan, and then you got North Korea versus the South, China versus Taiwan. It's everywhere. Europe. I mean, so when you turn the economy down like this, and we see it getting much worse going into 2028, all these disputes will rise to the surface. And that's what our computer's been projecting. And I think it's been the best thing out there since sliced bread. It's not biased. It's called all the shots correctly. It's been, I think, a light at the end of the tunnel to show us where we're actually going, and what hopefully that these republic forms of government will come to an end, and we'll go back more towards a direct democracy. Like, we should be asked, shall we go to war with Netanyahu against Iran? Congress was not even asked, no less the people. All right. And then they tell us we live in a democracy. This is total, absolute BS. We don't get to decide anything. Vietnam War, the same thing. You're 18, old enough to get drafted. You weren't old enough to even have a drink. You had to be 21 to vote. So, but that's democracy. No, it's not. This is all nothing but, pomp and circumstance. And, we should, cheer because we live in democracy and fight to the death for it. For what? Where's my right to vote?
The current phase of the market is defined by contradiction. Short-term flows continue to support the dollar, but underneath, structural pressure is building. Inflation remains elevated, and central banks are facing increasingly limited options. Recent commentary reflects that shift. In his latest commentary, edsteer emphasized that physical demand for gold and silver remains strong, even as paper markets create short-term volatility. This divergence often signals deeper accumulation by strong hands. At the same time, in a recent post, Martin Armstrong warned that geopolitical instability and monetary pressure are creating conditions for increased volatility across global markets. These insights reinforce a key idea. While short-term flows may distort price action, the underlying trend is being driven by structural forces. Positioning is quietly shifting beneath the surface. Let's get back to the interview.
Come to the point where somebody who is long demands delivery from the shorts and they don't have it and can't get it. And the short will have to go into the market and buy the physical in the spot market, and you'll see it in the price immediately. We saw signs of that earlier this, in January and late last year. So, there's a lot of signs that it's there, but it's up to the CME group. The CME group, keeps a very tight rein on their members. And if somebody is short and the long demands delivery, the first thing to do is the CME gets on the horn to the short, calls them up and says, do you have the physical to back this? And of course, the CME will know whether they got it or not because they keep records of this sort of thing. But one of these days that somebody's going to demand a huge amount of silver from the Comex, and the longs, the shorts aren't going to be able to deliver. It's as simple as that. And we'll see it in the price. Your first part of the question is that there's two ways for a person that is short to cover. Okay, if you're short a contract, there's two ways of covering it. You can either deliver the physical metal, or you can buy a offsetting long contract to cover it that way. And here's the thing that most people don't know is that most of the traders that are trading in the Comex futures market, their charters or their prospectuses do not allow them to take physical delivery. It's just strictly a paper game for them. So if you get into the managed money traders or the other reportables or the small traders, most of these guys are playing the paper game. And I have a lot of my subscribers that play the Comex futures market that never have any intention of taking delivery and can't if they had to. So even if they're long, the short can't deliver into them because they're not allowed to take physical delivery. So that forces who is ever short. They may have all the silver in the world. They may have 100 million ounces of silver to deliver, but if the long can't accept delivery because of their charter or their regulations, then they have to cover that short. They have to go and buy the paper contract to cover it, which of course drives up the price. So it's a very complex system on the inside. It's very simple, but very complex. And sooner or later, and as we've seen a couple of times in the last year, there have been issues for the shorts delivering to the longs, and these are what I call minor seismic events before we get to the really big one. And we had a major earthquake starting in January, and it's just a matter of when the next earthquake is going to show up and whether it's going to be the big one or not. Well, all these little technical things that have come along with this problem here, or there'd be cooling or this or that, or dropouts, or the market, shut down for, 9 hours or whatever the heck it is. These all stink to high heaven. It's sort of like there's smoke out there. If there's smoke, there's fire. This is they're getting more and more frequent. And as you pointed out, the LME nickel example was a case in point where the shorts could not deliver to the longs, and so the LME stepped in and canceled all the trades. And of course, that did enormous damage to the reputation of the London Metals Exchange. And I don't know if they fully recovered from that or not. I just don't know. The Comex, could they do that? Well, they did that back in the 1980-81 to the Hunt brothers, and I remember that because I was I was a buyer and seller of silver at that time too, and I was much younger. So yes, can the Comex change the rule? Yes, they certainly can. And as Ted Butler told me many times over the years, the sole purpose of the Chicago Mercantile Exchange, the CME Group, is to protect the large traders. So if things really become shove, it wouldn't surprise me at all if they stepped in front of the market and says, I'm sorry, we're just not going to allow this to happen. However, the difference between the LME and the Comex are enormous because most of the prices of the major commodities in the world are set on the Comex. And if they stepped in front of this freight train and tried to stop it, I think it would do irreparable damage. And what would happen then, and I've speculated on this before as have others, is that if the Comex decides to step in and, stop whatever price trend is in place, like we saw in silver at the end of January, but did it officially and said, no, we're not going to complete these trades, then I think you would see it would be pretty much the end of the Comex as we know it as a price setting mechanism. And the chances are excellent that the price mechanism would automatically transfer over to the Shanghai Gold Exchange, which is where it belongs anyway. Well, the first thing that people have to do is they have to decide, okay, whether they want paper gold or real gold. And my advice to everybody is the same thing. Gold and silver in hand is not simultaneously somebody else's liability where any paper asset is. So that's my first advice to anybody is invest your money in physical metal in hand first. And once you've got an adequate amount, and today's price is as good entry point as you're going to find anywhere, as far as I'm concerned, especially in silver. So if you want to invest today, this would be a good day to do it. And then you can decide whether you want to invest in paper gold or silver. And some funds are better than others, as far as I'm concerned. And then, of course, there's the entire spectrum of the precious metals equities, which are highly leveraged or supposed to be highly leveraged to the price in silver and gold. But over the last 3 or 4 months have been anything but. It's been really sad to watch the way that not only have the powers that be managed the precious metal prices, but they've also managed the prices of the shares as well.
What we're seeing now is not just short-term volatility, it's a transition phase. Inflation pressure, geopolitical instability, and monetary constraints are all colliding at once. In another recent tweet, Peter Schiff said, "The biggest mistake U.S. investors can make is holding too much cash." This reinforces the idea that purchasing power risk is becoming a central concern. Gold continues to act as a signal of systemic stress, while silver remains positioned for a potentially more aggressive move due to its dual role in monetary and industrial demand. When those forces align, price doesn't move gradually, it expands rapidly. If this pattern continues, the next phase could catch a lot of people off guard. Share your thoughts in the comments below. If you found this analysis valuable, make sure to like, subscribe, and turn on notifications so you don't miss what comes next.